Welcome to another episode of Good Value by Antipodes.
In the final episode for 2024, I'm joined by all the Antipodes Sector Portfolio Managers. For the next 30 minutes or so, they will share their thoughts on their specific areas of coverage as we head into the new year. Just as we did this time last year, I'm going to ask each portfolio manager for a stock they believe will be a winner in 2025 and a stock or area in their coverage to avoid. First up, we have Graham Hay, Antipodes Portfolio Manager of Hardware, Industrials and Commodities. Graham, welcome. How are you going?
I'm very well, Alison.
Now, before we get into our outlooks for 2025, let's quickly recap our 2024 picks. Our 5-stock, equally weighted, long-only portfolio returned 22% in US dollars compared to the MSCI ACWI's 20% as we record. So not a bad job, guys. Let's see a repeat of this for 2025. Graham, your stock pick for 2024 was TSMC. Fantastic pick. And you were cautious around the market's excitement around AI investment. Can you give a very quick debrief for us?
Yeah, sure. So TSMC was, it's a stock we've been involved in for 5 or 6 years now. So we knew the story quite well. And the stock performed very well in what was a good year for large cap technology, good year for semiconductors. If anything, 2024 confirmed the leadership position that the company have. If you look at their two main competitors, Samsung and Intel, both companies have gone into, crises of their own and that's very, I think, very much made it very clear that TSMC have a growing leadership position. And that was translated into share price performance through 2024. So, pleased to get that return. 2025 could be more challenging. On the broader AI thematic, look, if I go back to that statement I made, that was probably completely wrong. You should have totally embraced AI last year. It certainly was the predominant narrative through the market, and there were other ways to play it. Through software and one of the emerging themes was power consumption that supports AI data centers as well. That was very much a theme of 2024. The stock I actually had in mind when I said that was a company called Supermicro, which we were short in our long short funds. That stock actually did fall quite precipitously. There was an accounting irregularity identified, and margins came under pressure. The stock fell, I think, 80% from its highs. So we actually made money shorting AI, but you had to be very selective in doing that. So that's what we did.
And Graham, looking ahead to 2025, what is your stock pick, and can you match the performance of TSMC? No pressure.
Well, probably not, because I think 2025 is going to be a much more difficult year for markets. We've had 2 very, very strong years of returns, and I suspect we're in for a setback of some sort in 2025. So I think if you can pick something that produces an absolute return, probably in the 12% range, you'll have done reasonably well. So my pick for 2025 is Keysight Technologies, which is far from a household name, but the company has a very long history supplying innovative solutions for test and measurement across the technology landscape. So, if you're looking for a leadership company domiciled in the US that has high returns on capital, has recurring revenues and high return and high levels of R&D, look no further than Keysight. And the beauty is this is stock that's not at an all-time high. And trading, we think, relatively inexpensively versus its midterm earnings power. And it's come into the funds over the course of this year. And, through the last couple of quarters, we've seen a gradual turn in their order book, which we think reflects just the inevitable investment that goes on in test and measurement. Really, that's the cornerstone of all the innovation that's coming, whether that be 6G, whether that be AI data centers, innovations in automotive and other communication networks. Keysight are a critical enabler of all that innovation. And so, they've been through a down cycle recently, but we think, with their high levels of R&D and collaborative role they play with customers, they're very well positioned to, to flourish in the years ahead. So that'll be my pick for 2025.
And can you share a stock or a part of the market that investors should avoid?
Yeah, well, as I said, I think we've been through a couple of very strong years of returns, dominated, of course, by large cap technology stocks. So I guess it would be easy to say, look, be careful amongst that group of stocks. And that's probably right. But the truth is, trying to time the market is very tricky. You're better off not trying to time the market and being fully invested through time. So I would just say, look, be careful of the stuff that's done very well recently, but don't deny yourself the opportunity to earn good returns and do that via, diversified portfolios where you have access to exposure to companies with, positive risk reward outlooks. So I'd be reticent to say get out of the market because that's historically proven wrong. But just be mindful of how you're allocating your capital in 2025. I think we're in for a more difficult year than we've had in the last two.
Mm-mm. It almost feels like what we can be certain of is uncertainty for 2025.
Yeah, that's right. I mean, look, everyone's enthusiastic around the incoming U.S. administration and, the rebuilding America thesis. And I think there's validity to that. But I also think that there's a lot of uncertainty that comes with the policy regime that's about to come upon us. And we frankly don't know just what the outcomes might be. And they could well be negative in the initial phase because people are digesting a whole bunch of new information and economic circumstances that they weren't maybe predicting in any time in the last couple of years. So I'd be a little bit cautious on embracing that thematic off the bat. But certainly I do think there's an impetus to invest in reshoring and rebuilding critical infrastructure in the United States. So, we want to be part of that theme, but just be careful in the initial phase of it, I'd say.
Now, Graham, before you go and I introduce our next team member, a little end of year fun. What is your favourite Christmas movie?
Well, that's a good question. So I've gone with something that is maybe a little bit non-consensus here and maybe a little bit controversial. In 1990, there was a movie that came out called Trading Places, starring Dan Aykroyd and Eddie Murphy. Now, experts will tell you that this is not a Christmas movie. I beg to differ. Dan Aykroyd did dress up as Santa Claus. The movie was over the Christmas and New Year period. And this film is listed in the top 100 Christmas movies on Rotten Tomatoes. So I contend that it was a Christmas movie, although some 2019 research declared that it was in fact not a Christmas movie. So look, it was a great movie. I don't know if you go back that far. I do, but a lot of fun. Not a traditional Christmas film, but I think a great movie to revisit over the holiday period. Maybe not for your kids, but that's all right. Enjoy it anyway.
I'll allow it. You're allowed it, Graham. You can have that. Thanks for your time, Graham. Great to chat. My next guest is Nick Cameron, Portfolio Manager of Healthcare. Nick, it's been a while. Great to have you back.
Thanks, Alison. Good to be here.
So as with Graham, let's do a quick recap of your picks for this year. Alcon was your stock to own, and it's been a solid performer for most of the year, but has recently given a little bit of performance back. And an area to avoid was US managed care companies.
Yes, that's right. Thanks for that. And yeah, Alcon was a solid performer. It had really been hitting a lot of the key things that we were looking for. That is product launch cadence, and those launches did or performed better than expectations. We were also really looking for margin expansion and free cash flow improvement as well. And we pretty much got all of those things despite some pretty heavy FX headwinds and them cycling through higher input costs from the supply chain issues that occurred in the post-COVID period. So look, overall, we're really pleased with how Alcon performed. It was up nearly close to 30% at one stage for the year, but like you mentioned, started giving some of that back, particularly in the last month, where there was a bit of softness around the third quarter result. And that was really just around a few temporary issues that we think, and as we'll probably talk about later, much better set up into next year. And as for our avoid area, the managed care sector actually was, fairly muted over the year. It's been one of the most loved areas in healthcare. And in particular, towards the end of the year, there was a lot of volatility that we saw in the managed care's names, like whether it's United, Elevance, Cigna. They're some of the major managed care names that are listed that we cover. And what we were really looking for or were concerned about at the start of this year was just how we were concerned that the post-COVID rebound in healthcare utilisation, like use of healthcare services and surgical procedures, would be a little bit more durable than perhaps people were expecting. And we also saw some risks from a product mix or from a government reimbursement perspective, and that tended to play out towards the latter half of the year in terms of what was called the Medicaid redeterminations, and also some risk around reimbursement for a particular government program called Medicare Advantage.
And what is your stock pick for healthcare over the year ahead?
Now, I'm going to be boring, but I think with the pullback we recently talked about in Alcon, we're going to stick with Alcon for 2025. And the reason is number one, this is a company that is about to enter a very significant ramp up in new product launches. They've got a number of new launches planned, including a new surgical equipment platform, which should be well received amongst ophthalmologists and eye surgical practices. And it has the potential also to pull through consumables that go lock and key with that system, which attract a higher price. So there's that. We also see new advanced cataract and contact lenses coming to the market, and also the potential launch or FDA approval of a new eye drug coming to the market. So putting all of those together, they've got a lot of new product launches which should support revenue growth acceleration and above what we think above consensus revenues. And margins should expand in the latter half of the year significantly after the initial cost to support those launches, roll off. So really, we're looking for a very strong year of product launches and revenue growth. And also remember, we've got free cash flow accelerating, which we think the company will use to fund bolt-on acquisitions, whether it be in the drug pipeline for eyes or potentially even in surgical products, which would be a source of upside to our case.
Okay, so continued strong outlook for Alcon. And what is one stock or a part of the market that investors should avoid?
Again, I'm going to be boring, and this is our long-term, or what we would have called the view for the last few years with managed care companies in the US. And there's some of the similar themes as to why we avoided it last year that are going to play out again this year. But I'd probably highlight a couple of newer ones. One is with the changes that came through with the Inflation Reduction Act. There's changes that are going to be implemented from the 1st of January 2025, and that has to do with seniors' drug benefit design. So we think there could be some, significant, let's call it volatility around earnings to do with that new system that's coming into place, and that's around those managed care companies or health insurers that also have pharmacy benefit managers or effectively like drug insurance. We also are looking out for Medicare Advantage, which is a program that these commercial managed care companies run on behalf of the US government for their seniors. Medicare Advantage is a very popular product amongst seniors in the US, and we've had a long-held concern that these managed care companies have been over-earning or potentially even gaming the system in Medicare Advantage. And we think that the government has woken up to this, and we saw a little bit of this year, particularly towards the end of the year. And we expect that, there might be some more volatility around that for these businesses next year. And I think, I might just make a broader comment too. I think it's generally going to be a pretty volatile year for healthcare, and we have to prepare for a lot more headline risk, even more than what we're used to, which is still a lot. And I think that's really as what many of you will have seen in the news. Post the Trump winning the election, he has nominated some highly controversial people to some very key positions within healthcare. And so, we don't have a lot of visibility or a lot of clarity on what those policy choices might be of those people, but that is just uncertainty across the board. So I just thought I'd flag that too.
And finally, your favourite Christmas movie?
Look, this was a tough one for me, and I have to say it's a tie, and it comes down to Donald Duck's Christmas, which I think was part of Mickey Mouse's Once Upon a Christmas, and also the Polar Express. It was those two. And the reason being is my son, when he was little, absolutely loved those movies. And at this time of year, they are on repeat and repeat and repeat. And I actually love them. I grew to love them a lot. So good memories from those.
I have to say the Polar Express is one that has been watched many times in my household as well. So good pick. Thank you, Nick.
Thanks, Alison.
Now it's time to turn to Max Shramchenko, PM of Infrastructure. Again, Max, great to have you back on the podcast. Are you ready?
Yeah, Alison, hello.
So let's start with our 2024 recap. You picked American Electric Power, which was a solid performer all year, and you avoided highly geared real estate.
That's right. So yeah, look, with AEP, it's done pretty well in the first half of the year, but then we actually saw an opportunity to recycle some of that capital into a similar idea called Ameren. And actually that worked out pretty quick as well, relative to our anticipation. So towards the back end of the year, we actually pivoted back to AEP. So it's really our core regulated utility holding. And we continue to quite like, the load growth profile and the upgraded CAPEX plan. The new CEO has a very solid background. So all up, you're getting close to 4% dividend yield and 7% earnings growth. So that's a very good return for the risk taken. Plus, you have an opportunity to re-rate closer to peers as execution improves. And similar to the last year on the avoid side, we continue to remain cautious on REITs as a sector. Tail risk scenarios right now is you either see a rise in long-term rates or you get a US recession, or you may get both. And in neither of those scenarios, it's a great environment for REITs. So with this backdrop, I find attractively priced utilities like AEP as a superior risk-reward choice.
Mm-hmm. And so what's your stock pick for the year ahead?
Yeah, well, thanks for that question. And unlike last year, I have a deep value contrarian idea this time. A company called RWE out of Germany. So they are an independent power producer. They own a mix of contracted renewable as well as merchant conventional power generation assets. Look, it's a complex story in terms of the equity with a number of moving parts, and it's proven to be a very hard one for the management team to communicate well to market. Now, we've looked at the story for a long time, pretty much since 2016, and it's actually been a very well-run company and a compelling and successful energy transition story as well. Through a number of value-creative acquisitions and transactions, this management team has turned the company from what once used to be an over-levered, vertically integrated utility into what is currently a leading global developer and owner of renewable power. At the current share price, the market is only valuing the earnings power from the existing operating renewable assets. That means that the value of its 11 gigawatt of renewable assets under construction, along with 18 gigawatts of operating gas and battery assets, along with all its JVs and trading business, are essentially for free. So the market still sees this company as a value trap. But the way we believe this will eventually be proven wrong is through good old execution. The company just continuing to invest billions each year at attractive rates of return and continuously growing its core renewables EBITDA by more than 10% per annum. So all up, I'm seeing close to 100% share upside here.
Okay, so we've got a mispriced winner of the energy transition. Now, what should investors avoid?
Actually, this one is pretty interesting. So I see quite a bubble forming in listed conventional power generation assets in the US. So namely stocks like Talon, Vistra, and Constellation. These are the companies we know fairly well, and we used to own them in the past at different points in time. Nowadays, though, there is a lot of hot money chasing this space. A lot of people who, never looked at the deregulated power markets before. The revenue of companies in those markets can be extremely volatile, and right now they're at a cyclical peak. So normally, market will put those earnings at pretty low multiple due to the inevitable expectation of normalization of these earnings. But right now, all this new money believes that this time is different because the AI boom will perpetuate these earnings. And the irony is the AI demand, which is undoubtedly there, I believe will actually come with its own power generation. And this creates overcapacity and actually destroys earnings for the existing power plants. So let me explain this. Just like your aluminium smelter or refinery, these AI data centers are just too large to draw power from the grid without having a dedicated generation source nearby. And what we also know about the profile of consumption of these AI tasks is they're very far from being constant over time. So you can see power ramp up and down tens or even hundreds of megawatts in a matter of minutes. All this means that your data center needs to build a lot more generation capacity than what it will end up using on average throughout the year. Therefore, all this excess capacity will hit the market and deflate economics for existing generators. It's actually a big win for all the power consumers, as all these tech companies funding this will essentially bankroll the large expansionary capex for everybody. I'm sure state regulators and public utility commissions understand this dynamic, so they'd be very smart not to let the existing generators make too much money in this environment, as essentially there is no need to tap into the pockets of the ratepayers to send a price signal to add generation capacity. The signal is very much already there and well received. I mean, just take a look at the tens of billions of dollars of PE funds that we've recently seen launched to fund this infrastructure. So whilst the market believes AI is a holy grail for the merchant power generators, I think it actually may be quite the opposite. And as always with these things, Alison, time will tell.
Yeah, that's right. So it's that comment around absolutely there's going to be demand for power from AI, but it's just not going to come from the grid. That's the risk.
Yeah, it will come funded from a source on the side.
Well, that will prove to be a very interesting thing to watch, Max. Now, what is your final question? Our fun question. What is your favourite Christmas movie?
Yeah, look, I got a 6-year-old at home, so Home Alone is an absolute winner for me. We all need a bit of laughter every now and then, and that one does it perfectly for us.
Max, I don't think you need to have a 6-year-old to have Home Alone at the top of your list of favourite Christmas movies. It's definitely one of mine. Thanks, Max. Thanks for joining us.
Thank you, Alison.
Next, we'll pivot to the more domestic parts of the market, starting with James Rodda, Portfolio Manager of Developed Markets and the Antipodes Global SMID Strategy. Welcome, James.
Hi, Alison.
So just as with Graham, Nick and Max, we'll start with your picks for 2024. You had Oracle as a buy, but more broadly avoiding mega caps. Oracle has been a great stock this year.
Yep, look, Oracle's done very well, Alison. It was our largest position in the fund for a period. I think it was up around 80% from that recommendation point. And the case has really played out around it becoming the fourth major public cloud. It's done very well with AI customers in particular. In terms of current thoughts, there's less upside to our target price than there was, so the position's been reduced, but the story's playing out well.
And James, how about the performance of mega caps?
Sure, yeah. And in terms of that, the S&P and the NASDAQ outperformed by around 10% for the year compared to, let's say, small caps and mid caps if you look at the US performance there. So that gap was around 20% in July, and small and mid caps sort of nearly closed that gap fully post-Trump, and then it's expanded again over the last month. So that small and mid cap versus large cap has underperformed by about 10% for the year.
Okay, so let's move to 2025. What is the one stock that you believe will perform in the year ahead?
I'm going with Google, Alison, a mega cap, despite saying that. We've increased our size recently. We've done a video on our LinkedIn for people who want more detail. But the simple story is search is doing really well. It's growing double digit, and there's margin expansion as they focus more on their costs. AI overviews are doing really well initially within search, and the company says they're monetizing as well as traditional search. That removes one bear case. Their TPUs are behind GPUs for AI semiconductors, but the Gemini model was briefly the world's best model again recently, and it oscillates around the top, being the top model whenever there's a new release. Probably one other point on the bear case and why the stock's on, we think, 16 times 2026 earnings. 3 months ago, I did a test of no Google for 3 months. Used ChatGPT, Bing, Gemini, Perplexity, and whilst they work well for better, or better for many queries, Google is the Swiss Army knife, and they're not just super functional in services, travel, e-commerce, local, and maps, things like that these LLMs just can't really compete in. They're now integrated with Gemini, and these AI overviews are neutralizing the area where perhaps Google search was weaker, and keeping their overall lead. More broadly, the multiple ways of winning for Google extends out to YouTube and Google Cloud, which are both doing quite well also.
I just absolutely love that analogy you just used there, the Swiss Army knife. And, some great points there. Search has proven to be more resilient. And also, here we have a very attractively priced AI winner. 16 times was the multiple you called out. What should investors avoid?
I'm going to stick with the same as the prior year, Alison, US large cap. Look, we look at a lot of industries and companies. And what I would say is the collection of large cap, particularly quality, is priced for perfection in many cases in the US, and is also at the index level. So the great opportunities where you can really look at the business, look at the industry, and say, right, my expected return is sufficiently positive and I have a margin of safety. They're not that obvious in US large cap. So I'm going to stick with that. We see better value in the smaller and mid-cap names in the US and overseas listed companies in general.
Mm-mm. And what is your favourite Christmas movie?
Home Alone, Alison.
James, you will be pleased to know that, I hope you'll be pleased to know, that is also Max's favourite Christmas movie, and I love it. So the three of us will be, I'll bring the popcorn, guys, so the three of us can watch that this Christmas. Thank you very much, James.
Thanks, Alice.
John, last but not least, we'll start with your 2024 recap. Buy Brazilian grocer Sendas and avoid consumer staples in India. Look, the market was disappointed with the Lula government's revised fiscal targets to accommodate more spending in Brazil. And look, that weighed on Sendas' stock performance, didn't it?
Yeah, that's right. Look, what it meant was that Brazilian interest rates blew out by about 3 percentage points. So now the 10-year is at 14%. And that was over a period where the US Fed shifted to cutting. So that really weighed on Sendas, which has got a high debt load and impacted its interest expense. Look, we've maintained our position. The company fundamentals remain sound. And the impact to earnings has really been entirely due from that higher interest charge. Strong cash generation remains, and the company's efforts to extend its debt maturities has really pushed out the upside. The stock now trades on about 8 times 2026 earnings, and that's on the current 14% 10-year rate, which I think is still quite excessive. So we think that's very attractive for the resilience and growth of this business, that It truly has. The other one, Indian consumer staples. So the returns there were flat for the year, which was, underperformed a pretty hot Indian market that was up 20% in US dollars, and the EM market that was up about 6% in US dollars.
Mm-hmm. Okay. So as we look to 2025, what is your stock pick?
Yeah, so look, the stock I'm going to talk about is Didi, the ride-hailing business that those listeners in Australia would know of. They have operations here, but they are the leading ride-hailing app in China, and they've also got a strong presence in Latin America, where they hold circa 40% share in key markets like Brazil and Mexico. So this company ran afoul of the Chinese regulator when it first listed in the US, which saw it banned from the local app store, and it resulted in it being delisted from the New York Stock Exchange and effectively has traded over the counter since. So despite that disruption, the fundamentals of the business really went from strength to strength. Market share has been maintained over 70% in China through that whole period. They've turned profitable with an EBIT to GMV margin of over 3% this year, whilst they grew transactional revenue by over 10% this year, which is, as we all know, has been a very weak consumer environment in China. And so looking forward, this company is on track to see margins in China improve from over 3% to high single digits in the next 5 years. And we've done a lot of work to get confidence around this and really comparing the unit economics and the market structure relative to what we see in Uber's and Grab's markets that are respective leaders in the countries they operate in. And then you look internationally, we think Didi will be profitable in Latin America over the next 3 years, even whilst it grows its food delivery business, effectively expanding its addressable market. So today you can buy this company on 6 times 2026 EBITDA. That compares to 14 times for Uber and 14 times for Grab for their respective similar businesses. And really a large part of this discount is explained by Didi trading over the counter rather than on a widely accessible exchange. And in the next year, we expect it to relist on Hong Kong Stock Exchange, which we think will be a catalyst to close this gap.
Okay, we've got an attractively priced platform business that's seen good growth, and on those numbers you called out, it's priced at less than half the valuation of its peers. And so what should investors avoid?
Yeah, look, for avoid, I'm going to be looking towards the Indian market again for the coming year, but this time specifically looking at the Indian mid-cap universe that has really, increased substantially on local retail flows, and we think to valuations that are unsustainable. So if you look at the Nifty mid-cap PE for the next 12 months is currently at 38 times. And that compares to an average multiple since 2010 of 24 times. So, look, Indian mid-caps have always been trading at premiums, but we think that this level is quite excessive. And that's particularly at a time when EM is trading at material discounts to its history across all the markets, and there are signs of growth moderating in India. So if we sort of go through a few of these numbers, GDP growth in the quarter to September in India was 5.4%, which is still very respectable, but was below the RBI's target of 7.1. Inflation has increased to 6.2, which is affected by some transitory factors, but the currency has also started to weaken after an extended period of stability. So all of this dampens the ability for the RBI to cut rates just when it might be needed. We've seen it impacting company earnings already. So through the September quarter, companies missed on average, company earnings missed by 8% on the back of heavier monsoons and weaker activity around the election. So, yeah, some of those effects are transitory, but when we look at sell-side analyst estimates, they've only been cut by 3% for the full year, which could prove to be quite optimistic when you see some of the slowing down that's happening. Lastly, on this point, we're seeing record levels of share issuances in India. So when we look combining primary and secondary issuances over the last 12 months, it's reached $55 billion, which is almost 2 times higher than the previous peak level of issuances. And there's been a very strong correlation between peak issuances and market corrections. So these factors, whilst we remain at these peak valuations, I think positions us to avoid the Indian mid-cap space at the moment.
That valuation really does appear quite disconnected from some of those that macro data and that earnings data that you called out, particularly that potential for downgrades.
Yeah.
And John, finally, our fun question, your favourite Christmas movie?
I'm going to have to go for Elf, which, I've watched it a few times with the kids, but I find it very funny every time I watch it. There's always a lot of good quality humour in that movie. Which you remind me of that movie now, so I'll have to watch it with them this weekend.
Actually, that is my son's favourite Christmas movie. So that is his humour all over. So I'll be sending him to your house to join in. As always, thank you for your time, John.
Thank you.
I hope you've enjoyed this episode. We've covered a lot of ground, ranging from a testing and measurement company that enables innovation in AI data centres, automotive and communications, to a healthcare company on the precipice of a number of new product launches, a mispriced winner in the energy transition, an underappreciated AI winner with additional ways of winning, to a platform business in China. From the Antipodes team, we wish you all a safe and happy holiday period. Keep up to date with us in the new year at antipodes.com or follow us on LinkedIn.
The content in this podcast is general information only. It is not advice of any kind. Seek professional advice before making any financial decisions, and remember, past performance is not a reliable indicator of future performance. Finally, stock commentary in this podcast is illustrative only and not a recommendation to buy, hold, or sell any security.